Good Monday morning, and today let's talk about Deutsche Bank. Now, there's an article in the FT that they've been kind of fighting with the ECB over how much they should be putting um, into the reserve against possible losses of their loans. And here's the clash. This is over bad loan losses. I want you to remember something when we're talking about these big banks. You have loans, and you have your investment book. Okay? Two totally separate things. And reserves against those are two totally different things. So this we're going to talk about are what their bad loan losses could be. Okay? So the ECB and the Deutsche Bank have been fighting over two things: their credit risk management and their risk models. Remember, all these banks run their own models, believe it or not. So it's not that we have a standard model because the banks won't allow us to have one. So everyone has their own model, which then the ECB, in this case, has to work with. Over here is the Federal Reserve has to work with it. Now, they had provisioned 1.5 billion euros for bad loan losses. And the ECB said this was too low. They thought it should be minimum of 2.5 billion euros. Now, this is on a $485 billion loan book. So the 1.5 billion euros represents 0.003%. That's their coverage. And if you take it to 2.5, it would be a massive 0.005. Okay, so this is the first thing that we're going to look at here. And by the way, they gave a warning now saying that their bad loan losses could be worse, and their chief risk officer, he's leaving the firm in May, but basically probably forced out by the ECB. And this is all over their leveraged lending. They've been going back and forth with the ECB for years over this, okay? Okay, so that's their loan book, remember, 485 billion euros. Now look here in the bottom right-hand corner. This is their common equity, okay? $41 billion. Let's say $42 billion. And remember something, I've said this a million times. This is the only thing that a bank can write their losses off against the $42 billion, all right? And so think, they have a loan book of 485 billion. So their loan book is about 12 times how much equity they have, okay, which is $41 billion. But these big banks, we have levels, we call them level 1, level 2, and level 3. So you can see level 1 is the most liquid and easiest to value and basically sell, okay? Treasury bills, marketable securities, foreign currencies, gold bullion. Level 2 are more difficult, but they can still be fairly estimated. Remember that, critical word. Interest rate swaps, corporate bond and loans and active markets and derivatives with observable inputs, okay? So remember something, in derivatives we have like listed derivatives and unlisted derivatives. If you do a listed derivative, you have less reserve requirements versus unlisted. Trust me, most of the banks have moved over to the listed derivatives because they don't have to put up so much reserve. But then we have level 3 assets, okay? And these are mortgage-backed securities, private equity shares, complex derivatives, and distressed debt. So the complex derivatives are unlisted derivatives, okay? And distressed debt. And the valuation relies on unobservable inputs and complex models known, as we call it in the industry, mark the model, right? So think about it. We mark to market like our securities that we actually can price. When we can't price the securities, we mark to model. And remember something, the banks build their own model, okay? Now, I asked Perplexity about how big is their trading book. It's around $400 billion, okay? And, but notice in the second paragraph there, as of March 31st, 2024, they had 24 billion in level 3 assets. Okay, so let's think of the numbers. We had $42 billion to start with. We have 485 billion euros, okay, in loans. We have another $400 billion in trading book. And yet, we know that we have about 5.7 billion in bad loans, okay, that's one. Two, we have 24 billion in level 3 assets. So that's around 30 billion. And then you have the level 2 assets, which are not that easily priced, trust me, okay? And by the way, these banks, we maneuver between level 1, level 2, and level 3. Because if you're in level 2, it's something that's discernible and the Fed or the ECB could take issue with it. But when you put it in level 3, you can hide it a lot better. Now, people don't like having level 3 assets. But as Perplexity points out here, the level 3 assets, and they first tell you should read this on how hard that's to price. Basically, it's impossible to price. But they say, no big deal. This is a very small percentage of a bank's capital. Well, I got $42 billion and I got $24 billion in level 3 assets. That is not a small percent, okay? And then you have $5.7 billion in loans that you admit that are no good. So that's 30 billion. So now you got 14 billion. Now you got 14 billion on top of basically 900 billion. So basically around 30 times it's trading. And by again, if they lose 3 or 4 or 5 billion dollars, they're gone. They're gone now, but this is the game that we play, okay? So what are we talking about here? We're talking about the biggest bank in Germany, which is the biggest economy in Germany, that basically has almost zero capital, and they have $900 billion in investments out there in leveraged loans. I mean, they're under attack from the ECB, not because of what they're invested in, which obviously isn't that good since they have 24 billion in level 3 assets, but because of the $485 billion in their loan book, they say they have way too much leveraged loans in there. So, what does this all mean? It means that, until the markets call us on the carpet, which always happens, okay, we're all just gonna, act like the emperor has new clothes instead of no clothes. Like and follow. Tell me what you think in the comments.